Hello, traders, and welcome to a new episode of Beyond the Charts. In this episode, as always, we're going to break down everything that has happened in the past week. We're talking fundamentally, of course, and we're going to go through the weekly high impact news calendar day by day, and we'll break down every single data point that has been released in the past week so that we can understand or better understand the environment that has been going on for the past week so that we can build on it for our trading and setups for the next week. So let's get to it without any further ado. We start with Tuesday because on Monday we had nothing of high impact, so we start on Tuesday. We had only one high impact reading or data release, which was the consumer confidence coming from the US. The previous reading was at 95.6, the forecast was at 93.4, and the actual came in higher than expectations or slightly higher than expectations at 94.6. Now, consumers are feeling a tad more optimistic than expected on jobs and income, but inflation worries still linger, which signals steady spending without any boom. All right, so how did that impact the market? In terms of stocks and indices, consumer stocks went up 0.3%. We're talking Walmart and such stocks. The S&P 500 gained 0.4% on mild positivity. The gold remained flat. It didn't move the market much. The FX majors, we're talking the USD, since this is coming from the US. The USD gained 0.1%, and naturally it reflected negatively on other pairs like Euro USD, GBP USD, and USD JPY. Okay, so that's it for Tuesday. Let's move to the next one. The next one is Wednesday. Now, I think it's safe to say that this week has been or the past week, sorry, has been the week of central banks, because we had interest rate decisions coming from Canada, from the US, from Japan. So a lot of interest rate decisions this week. So we can safely call it the monetary policy week. All right, so we start with Canada. They had the interest rate decision, the Bank of Canada interest rate decision. The previous reading was at 2.5%. They expected to cut 25 basis points, and the expectation and the actual reading came in line with expectations at 2.25%. So they cut 25 basis points. All right. So what does that mean? It means that it came in line with expectations, so no surprises. But this was like a dovish move to support growth amid low inflation, with more easing hinted if jobs soften. So if the Bank of Canada said if there's more room for easing, if the jobs market needed that softening, okay? So how did that impact the market? As I told you, it wasn't a surprise, so not much. But the stocks and indices from Canada was like the stocks TSX gained 0.5%. The US indices gained 0.2% because of the spillover. They're very close to each other, so it makes sense that it went up slightly. USD CAD gained 0.3% which means that the Canadian dollar weakened, because when the USD CAD goes up, it means that the Canadian became weaker. Okay. Now that's it for the Bank of Canada. Then we had the crude oil inventories. The previous reading was a shortage of 0.961 million barrels, and the forecast was a shortage of minus 9 million barrels, but the actual reading came in also like a shortage, and like a sharper shortage than the previous reading, but not as expected. It was lower than expectations. So the shortage was minus 6.858 million barrels, which is not as bad as a shortage of 9 million barrels. So this was positive for the oil prices, of course, because shortage means either high demand or tight supply, and both are good for the oil prices. Um, so what did that do to the markets? Energy stocks went up 1.2%. The S&P gained 0.6%. The gold went back 0.4% as risk on mood took over from energy. USD gained 0.4%. Euro USD lost 0.4% naturally because it's against the US dollar. And the USD JPY gained 0.5%. All right, now let's move to the next one, which is the FOMC statement. Now, in their statement, there was a slight change this time. They cut 25 basis points, of course. It's been like in the headlines all over the place last week. So we knew that they cut interest rates, but in their statement, the Fed noted that the progress toward the 2% inflation is still ongoing. The inflation remains somewhat elevated in comparison to their 2% target. Now it's at 3%. But the labor market is cooling, so this rate cut is necessary. But there was like a big surprise um, that came from Jerome Powell during the press conference. I'll tell you about it in a bit, but for now, the statement was like they cut 25 basis points. It said that they decided to cut 25 basis points. After that, they said that inflation is still somewhat elevated and the labor market is cooling. So the 25 basis points, the 25 basis point cut was needed. All right. So they will say data dependent. That's what they said in the statement. So what that meant at that moment when this statement came out or was released, it was a dovish confirmation. It means the easing cycle is continuing, but Jerome Powell had something else to say. So after they cut the interest rates, 30 minutes after the interest rate decision, there was a press conference for the FOMC, and Jerome Powell stated that, okay, we needed this 25 basis point cut, but don't be so optimistic on the December cut. It doesn't mean that we started the cycle and we're going to keep cutting rates. And he actually said one line that ignited the markets. Stocks fell, everything. He said, a December cut is far from certain. He said, a December cut is far from certain. It means that don't count on a cut coming in December, which was being priced in by the markets. That's why we saw all-time highs on indices and anything and everything else priced against the US dollar. We saw all-time highs on indices. We saw all-time highs on gold, on silver. So in the past period, I'm talking not only last week. So this line destroyed the hopes that there will be another rate cut in December. Okay, so that's it for Wednesday. We're done with the FOMC press conference. Now let's move to the next, which is Thursday. Now on Thursday, what did we have? We had the Bank of Japan interest rate decision. As I told you, this week has been filled with, or the past week, I mean. Past week has been filled with interest rate decisions from different central banks. We saw the Bank of Canada. Now we saw the Fed, the Federal Reserve of the US, and we saw Bank of Japan. Now the previous reading was 0.5%. The forecast was no change at 0.5%, and the actual came in line with expectations at 0.5%. So they held steady, basically. The Bank of Japan is being patient on hikes. They're watching yen and inflation, but the dovish bias still persists. Okay, now how did that impact the markets? The Nikkei index gained 0.4%. The Nasdaq in the US gained 0.2%. The gold stayed flat, and the USD JPY lost 0.2%, meaning that JPY strengthened. Now, the next one is the German GDP, quarter over quarter. Now, the previous reading was at minus 0.3%. Okay. The forecast was 0.0%, and the actual came in line with expectations at also 0%. So what does that mean? It means that it matched expectations. So the Eurozone engine remained steady, so no growth in Germany, from quarter to quarter, but it was as expected, so there was no major movements after this release. The DAX gained 0.3%, the gold stayed neutral, and the FX majors, mainly talking about the Euro USD, gained 0.1%, and that's it. Now, there was another number, the monthly number, the German CPI. That was the quarterly number that we just finished talking about. Now we have the German CPI monthly number. So the previous reading was at 0.2%. The forecast was at 0.2%, so no change. But the actual came in higher than expectations at 0.3%. So a slight beat to expectations, but still positive. So there was a monthly rebound from contraction. Construction and services were strong. Stocks and indices gained some steam. The DAX gained 0.4%, and the gold lost 0.1%. The FX majors, mainly talking about the Euro USD, gained 0.2%. Now, another central bank. We had the deposit facility rate coming from the ECB, the European Central Bank. The deposit facility rate did not change. The previous was 2%, the forecast was 2%, and the actual was also 2%. So no change there. And we had the interest rate decision, which is the funds rate. We saw a 2.15% previous reading. The forecast was no change, and the actual number came in line with expectations with no change to previous numbers. So the ECB is still steady and no easing yet amid sticky core inflation, because like in Europe now, the inflation or the core inflation is still sticky. So they're trying to keep their rates higher a little bit longer so that they see a reaction. And now we had later on that week or past week, we had also the Euro CPI. We'll get to that in a minute, which is the Eurozone inflation. But they kept the interest rates as is. They do not change anything. And the Euro stocks gained 0.2% after this release. The gold remained flat, and the Euro USD gained 0.1%. So no major movement, because nothing was so surprising. Okay. Now, there was a press conference for Christine Lagarde afterwards. It was like 30 minutes after the release. So what happened there? Lagarde noted that inflation is progressing, but tariffs impose upside risk. So there will be no November cut, but there's a flexible path. So if they saw the need to cut rates, they will cut rates. But so far, they're not seeing the need, and I agree with them. Looking at the Eurozone economy, or let's say inflation numbers and progress. So this was a cautious hold. The ECB is watching the US shutdown spillover. So they decided, no, we're not going to cut rates. So after the press conference, the Euro stocks gained 0.4%, the gold gained 0.3%, and the FX majors, mainly talking about the Euro USD, gained 0.4%. Now, finally, we move to Friday. So what did we have on Friday? We had the Euro CPI. Okay, so Eurozone CPI the previous reading was 2.2%, the forecast was 2.1%, and the actual number came in line with expectations and lower than the previous reading at 2.1%. So what does that mean? It simply means there's a slight dip closer to target. This inflation continues, which means that the ECB is doing the right thing by keeping interest rates higher for longer. They're not cutting rates to fight the inflation and bring it down to the 2% target. The market impact was also very mild. The Euro stocks gained 0.2%. The gold gained 0.1%, and the Euro USD gained 0.2%. And now next we had the Chicago PMI coming from the US. The previous reading was at 40.6 points. The forecast is 42. And the actual reading came in higher than expectations. This calendar was not updated, but the real number or the actual reading was at 43.2. So it was higher than the forecast, which is positive for the US dollar, but still below the 50 mark, which is anything below 50. The PMI numbers, I mentioned this many times, but I'm going to say it again. Anything below 50 is in the contraction zone or territory. Anything above 50 is expansion territory. So although it came in higher than expectations, it's still considered in the contraction zone. So it's not a very positive number. It's better than the past number, but it's not a very good number anyway. So the market impact wasn't so great. It wasn't very volatile. It was a very mild movement after this release. So guys, this is it for this episode. We broke down everything that has happened in the past week. Keep an eye on inflation numbers coming from the US, from Europe, from the UK. These numbers are going to be very important in the next period because they will set the tone for the next interest rate decision meetings coming in November and December. So on December 10th, there's going to be another interest rate decision. The markets now expect a lower probability of a rate cut on December 10th in comparison to what the situation was before Jerome Powell said that one line that actually dropped the markets, and the market turned red right after his one line, which was a December cut is far from certain. They're going to watch inflation data, they're going to watch the jobs market data, and accordingly they're going to adapt, or they're going to cut or not cut according to that. So the shutdown still persists in the US. Some people are expecting it to extend till the end of year, but no one works in the US government. None of those people making those speculations work in the US government, so there is no way that we can know. Our job as traders is to keep an eye for data, always use stops, trade responsibly, and follow fundamentals, not to trade or not to execute, but to refine our trading setups and make sure that the fundamentals are endorsing our analysis or technical analysis. Okay, so I hope this was helpful. I hope it was fun. I hope I didn't bore you, but this week we had, or the past week we had some action, unlike the past week, or the week before. So yeah, I enjoyed this. I hope you enjoyed it. So take care of yourselves, and I'll see you on the next one. Take care.